I'm joined by Philip Manduca, Head of Investment at ECU. Philip, thank you so much for joining us. Now, it does seem that actually we're just getting worse news now. We had better news in terms of the economy, the data. Now Bernanke's saying, well, guys, watch out. And we also had this extra stimulus in Japan today. We're not out of the woods.
Well, not all out of the woods by a long way, and everyone knows that, and all the top leaders are admitting that. Where we are, I think, is between the hot patch that we entered the third quarter and fourth quarter zone and the weak patch, which we came in before even that. So we've got into this sort of more moderate area now, where it's slightly more sticky growth. Yes, it's still showing growth. No, it's not showing it at the same pace that it was coming into this. So the question everybody's got is not what's going on now, hence the real lack of reaction to last Friday's non-farm payrolls, which was surprising. No, that's not really what's the matter. The matter really is, where does this go in the first 4 months of next year? Is it going to pick up a little bit more, or is it going to retrench, and what does that mean for government involvement?
And what does it mean for the markets? Are we going to see a strong correction? We've seen this incredible rally over 6-7 months, which can't be sustained, really.
Well, no one knows, Francine, obviously. I mean, everyone has a view, and everyone does have a view at the moment. It's the most polarised market in terms of analysis you'll ever get. My own view, for the little that it's worth, is that I think that equities are going to be a non-performer in 2010. I don't think we're going to see a crash, and I don't think we're going to see a boom. I think there's going to be just enough economic news to sustain current valuations. There's going to be very easy monetary conditions. There's going to be continued easy fiscal conditions, despite all the rhetoric that we've got to cut back on public sector involvement. I don't see how we cut back on public sector involvement, because the private sector just is not going to be able to replace it. So you're going to see a lot of stimulus still going through, but there just isn't going to be that degree of final consumer demand with a lack of waging power to generate consumption. And that means we're probably going to go nowhere economically. Not too weak, not too strong, not a great environment for equities to push up. Now, pretty moderate stuff.
You say positioning is significant for the month of December. What would you be a buyer of? How much equities, how much gold, and how much currencies?
Well, the positioning is very important. It's always important in markets, none more so than, of course, in December. I think the market remains pretty short of dollars. Our call here is that the dollar picks up through the course of December, temporarily, we think. But I think that's the likely positioning squeeze that you get. Markets are always looking for vulnerability, always looking for the place of pain, and the place of pain right now would be a short covering rally in dollars. Where is the place of pain in equities? Well, for much of this year, I felt that it's higher. Everybody's been trying to call a level, whether it was 965 on the S&P or 1010, 1050, 11, 1120. They're now talking about 1120 and 1150 as crucial levels on that S&P. My own view is that the market's pretty much in equilibrium right now. The wealth management, high net worths, family offices remain out of the market. Institutions are in. Don't expect too much fireworks going in. There will try to be a reflationary rally in that first month or two, but I don't expect it to go too far in stocks.
Now, Philip, I want to talk to you also about Dubai. We're hearing news today that actually some other companies may be forced to talk with their creditors. Now, you say Dubai is all about Iran.
Well, I think it's mostly about Iran. I think that, America sets the politics in the Middle East. Abu Dhabi sets the politics in Dubai. And Dubai's been dealing with Iran, and it's a major trading partner of Iran. And America's trying to get a deal in Iran right now to get back on this nuclear story. The pressure's been applied on Dubai. Stop trading with Iran. Abu Dhabi's been asked to apply that pressure, and Dubai's getting hit somewhat as a consequence of it. But it is only part of the story. Iran is part of that Dubai story. The bigger part, the more macro part for investors, I think, is why not? Why doesn't Dubai just tell the banks, take a haircut? Russia did it in 1998. People were lending to Russia within 18 months. It set the pattern. I think you're going to see a lot in 2010 of institutions and maybe some sovereign states saying, listen, the game in town right now is default or restructure. We're going to do one of them. Why should we pay 100 pence on the pound in terms of our debts? Let's try and talk about a haircut here. And if what are you going to do about it? And the banks don't seem to be able to do anything about it.
I feel that Abu Dhabi will just come in with a massive check for Dubai, and we'll hear nothing more of it.
Let the banks take the pain, and that's been very much the story over the course of the last year, as we all know. I don't see, if I was, a creditor of these banks, I'd just say, look, can't pay. What are you going to do? Let's try and restructure. And I think the banks have already been very aggressive in their write-downs anyway. Yes, it'll lead to a lot of restructuring, but I expect a lot more pressure on the banks to try and discount some of that lending that they've done over the course of 2010. and the banks aren't going to be a pretty place to play as a consequence.
Phil, I also wanted to talk about rating agencies. Now, they are under line of fire again because they didn't spot Dubai. Yesterday, they came out...
I'm not sure what they did spot, but go on, Francine.
That's true. They didn't spot much, but should they have spotted Dubai when actually, well, the creditors didn't spot it? Our banks here went happily investing in Dubai and should have probably seen it coming as much as the rating
Francine,
agencies.
everyone's had a go at the banks. To be fair to the banks, I think they did to some extent see it coming. They've written it down to some degree already. They've already made provisions, and so everybody else saw it coming. No one could quite understand where all these apartments, except to a few football players, they were going to get filled. There was an enormous capacity and glut of property being built in Dubai, and the question everyone always asked was, what is it actually Dubai produces? Where is the money coming from? Well, we know where the money's been coming from, and it was bound to come to some sort of climax in a debt crunch, which is what we've got. I think the surprise about Dubai was not the crunch, but the way that they talked about it into that weekend and the suddenness of it and the announcement of it. Why did they have to go so high profile? And then you go back to the politics in Iran.
Philip, thank you so much.
Pleasure,
Great
Francine.
pleasure to speak to you. Philip Manduca there, Head of Investment at ECU.